Program is the active center. Program is the active center.
All right, let's dive in. Today, we're going to tackle a giant, Benjamin Graham's The Intelligent Investor. Now, this isn't about hot stock tips or getting rich quick. Nope, this is about a timeless framework, a whole mindset for success that can help you navigate pretty much any market.
So let's just kick things off with the one question Graham forces all of us to ask ourselves. When you put your money in the market, are you really investing, or are you maybe just gambling, just placing a bet and hoping for the best? Seriously, your answer to this changes everything.
You see, for Graham, the absolute first step on your journey is to consciously decide which of these two paths you're going to walk. They are not the same thing. And trust me, confusing them can be a really, really costly mistake.
Okay, so what's the actual difference? Well, Graham draws a very hard line in the sand here. An investor, they're analytical. Their number one focus is safety, then getting a reasonable or what he calls an adequate return. But most importantly, they know they're buying a piece of an actual real-world business. Now, the speculator, that's a totally different game. They're just betting on which way a price is going to move. They're not buying a business, they're buying a ticker symbol.
And here's the real kicker. For Graham, success has way less to do with being some kind of genius who can predict the future and everything to do with having the discipline and the emotional control to just stick to your plan. It's a game of character, not just about being smart.
So how do you manage that temperament? Well, to help us out, Graham gives us this absolutely brilliant mental tool. He actually introduces a character to help us picture the crazy, erratic nature of the stock market, the unforgettable Mr. Market. So picture this. You own a business, and you have a partner named Mr. Market. Some days, this guy is on top of the world, totally euphoric. He's convinced your business is the next big thing and offers to buy your shares at a ridiculously high price. But then, other days, he's a total wreck, deeply depressed, certain the business is doomed, and he offers to sell you his shares for pennies on the dollar. He is the market's mood swings in human form. And this right here is the whole point. You are not supposed to let Mr. Market's mood swings affect your own. His daily price quotes aren't a guide to what your business is actually worth. They're just a reflection of his crazy emotional state. His volatility isn't a threat to you. It's an opportunity. This turns the whole idea into a simple three-step process you can actually use. First, Mr. Market shows up with his emotional price. Second, and this is the most critical part, you completely ignore his mood and rely on your own homework, your own analysis of what the business is really worth. And third, you decide. You can take advantage of his pessimism and buy on the cheap, or cash in on his euphoria and sell high. Or, and this is a perfectly valid and powerful option, you can just ignore him completely and go about your day. You're in control, not him.
So if you're not listening to Mr. Market, what are you listening to? Well, you're listening to your own analysis, and that analysis has to be built on what Graham called the single most important principle of investing, the margin of safety.
In the simplest terms, the margin of safety just means you never, ever pay full price. You do the hard work to figure out what a business is truly or intrinsically worth, and then you insist on buying it for a whole lot less than that number.
And this is where we get Graham's famous goal, to buy $1 of assets for 50 cents. You see that 50-cent gap between the actual value and the price you paid? That's it. That's your margin of safety. It's your buffer, your cushion, your protection against all the crazy stuff that can happen.
And why is this buffer so important? Because let's be honest, the future is a total mystery. You could be wrong in your analysis. I mean, it happens. The company you invested in could hit a rough patch you didn't see coming. Or the entire market could just have a total panic attack. Your margin of safety is what protects your money from all of those risks.
Okay, so you need a margin of safety. But how in the world do you even begin to calculate that intrinsic value to begin with? Well, the key is to completely change how you think about what a stock even is. This is the foundational mindset shift Graham demands from all of us. You have to stop thinking of yourself as someone trading little ticker symbols on a screen and start thinking of yourself as a business owner, because that's what you are. You are buying a small piece of a real company with real buildings, real products, and real employees.
So what does that mean in practice? It means your decisions have to be based on the fundamentals of that business. You're looking at its financial health, its profits, its assets, how much debt it's carrying, and, how good the people running the show actually are. You ignore all the daily market chatter and just focus on the facts of the business itself.
But look, Graham was a realist.
He knew that not everyone has the time, the skill, or even the right temperament to do this kind of deep dive analysis on every single investment. So, he laid out two very distinct paths for the intelligent investor.
So on one side, you have the defensive or passive investor. Their main goal is pretty simple: safety and freedom from constant worry. They use straightforward, disciplined strategies, like having a simple portfolio of stocks and bonds and just buying consistently over time. Then you have the enterprising or active investor. This is the person who's willing to put in some serious time and effort to hunt for those deeply undervalued companies. And Graham is super clear about this. He warns that most people are way better suited to being successful defensive investors.
And that really brings us full circle, right back to the core message of the entire book. It's not about being the smartest person in the room. It's not about having a crystal ball. It's all about having the right emotional framework, the discipline to stick with your principles, and the humility to know what kind of investor you really are.
So, as we wrap this up, the final question Graham leaves us with is a really personal one. It forces you to look inward and ask yourself, are you actually building the patience, the discipline, and the emotional control you need to succeed? Because when it comes right down to it, your own temperament might be your greatest asset, or, yeah, your greatest liability.